welcome to today's discussion, which is themed Seizing Opportunities Amid COVID-19 Puzzle. And the question is, should you invest during a pandemic? Now, given our situation with COVID-19 measures, we have been disrupted significantly on how we do business, how we learn, how we bank, how we trade. The emphasis is now on online, now on digital platforms more than ever. Previously, when we have had these engagements, it has been in a more personal interaction over breakfast, in a conference room, in a hotel somewhere. But not to worry, when disruptions set in, we have to adopt and adjust to the circumstances just like everybody else. Our goal, however, remains committed to making sure we keep you informed, even as we social distance, so you can have the right information to make the right investment decisions. And that is why, as NCBA Investment Bank, we do provide a platform for deeper dialogue with us, with a view to give you an edge in the markets. I know we all have a lot of questions around our investments, and obviously around how long will this crisis last, what investment trends and opportunities are there, what kind of diversification strategies are there, and so much more, including the question, should you even invest in the first place, or is cash more important to hold at the moment? But it is Warren Buffett who once said, before you invest in something, invest in time to understand it. So that's why we're here today. We trust that by the end of this webinar, you will have some answers to some of the questions and also be enlightened on some investment opportunities. The fact is, COVID-19 and the pandemic itself has taken a toll on the economy and also on the global markets. The securities markets have been volatile, sometimes with high volumes, sometimes with low volumes, and even sometimes with dips in valuation. What we have seen though with some listed companies dipping in value, we find that the value is not commensurate to the fundamentals of the underlying companies. On the other hand, you will find companies that have grown and will grow even in the face of the pandemic, purely on sector-specific driven demand. For instance, technology-driven companies, internet service providers, and some manufacturing companies, just to state a few sectors, can thrive even under the current pandemic. Some of the concerns in the investment space during this time, and in regard to our topic of discussion today, is the fear that stems from the uncertainty we face. What we believe is that if you do have a long-term view, then opportunities do exist past this pandemic and the disruption, of course, it has come along with. Markets are very cyclical in nature, and that is just how markets work the world over. However, sitting out in a market that has dipped in valuation is missing out on some great opportunity. So ladies and gentlemen, with those few remarks, I thank you for honoring our invitation once again. Let me introduce you to our speakers for the day who will be helping us answer that question, should you invest during a pandemic. We are honored to have a chief guest speaker today, Mr. Terence Anzebesa. He's a chief officer in charge of the derivatives market at the Nairobi Securities Exchange. And he will be here to give us some more information on other alternative investments under the current situation. We also will be getting some remarks from our managing director, Ms. Catherine Nyamo, in the course of this presentation. We'll also hear from Mr. Samuel Gishoi, who's our head of business development, who will be taking us through some investment opportunities and investment strategies and really answering the question, should you invest during a pandemic? Last but not least, to set the scene, we shall have Dennis Kariuki, our analyst, who will give us a brief background on the macroeconomic environment. Now, before we start, should you have any questions, please use the Q&A tab to post your questions, and we shall address them at the end of the presentation. So just post it there, and once speakers are done, we'll revisit and answer those questions for you. So without much further ado, we are the bank that says, let's go for it, so let's go for it. And Dennis, over to you. Thank you.
Thank you, Catherine, and everyone, wherever you're joining us, welcome to this webinar. We are happy to have you this morning. Mine is to give you a snapshot of economic environment and the performance of financial markets, and offer some of our views on what we expect during the next part of the year. So to begin with is economic growth. We have all seen economies across the globe go into technical recessions, and some economies goes into recession. That is to mean negative growth for the year. In Kenya, we're expecting a base growth rate of about 1.5% for the year. And this is levels that we saw back in 2008 when we had the post-election violence and also the global financial crisis. So you can see how the pandemic has shattered every plans that the economies had put in place. That is to say, sectors that are going to suffer the most include tourism, hospitality, agriculture. Although horticulture sector has opened up a bit and also tea exports have resumed, we expect those sectors to be hammered a bit. Sectors that are likely to support the 1.5% growth include financial services and also the resumption in the manufacturing services activity. We expect that to have a boost on the economy. We have seen amid the pandemic, global credit rating agencies such as Moody's have cut our sovereign credit rating, and that is a bad signal towards the prospects of our economy. But we do expect 2021 to have a bigger resumption, but that's dependent on how long this pandemic stays with us towards third quarter and fourth quarter in the year. But it's a technical recession for the 4 quarters in 2020. Having a snapshot of interest rate environment and also inflation, we have seen inflation hold very steady within the government target of about 5%. In the month of May, it came at about 5.5%. And this was highly bolstered by the stable food prices. Also, although some commodities have had a spike, given the locust invasion and also the flooding. But we do expect stable weather conditions for the rest part of the year, and that food prices may not be a bigger risk for the next part of the year. Crude prices also gave a boost with petrol and diesel prices going down by double digits in the last couple of months. We expect that to have boosted our credit account balance. But to speak on that, oil prices have started to resume because of demand resumption in global economies. China is now operating at about 95% capacity, so demand has resumed on their oil. And that is to say oil prices are likely to spike, but we expect OPEC to come up with oil cuts that are likely to boost oil prices and remain, put them in on a hold that is likely to be good for oil importing countries. On the other hand, we see the Monetary Policy Committee engaging very heavily in the market to support financial services amid the pandemic. We have seen the CBR come down by about 200 bips in the year to the current level of about 7%. The transmission of the CBR cut is what remains a key challenge in supporting the economy. But we see that the interest rate level remains accommodative for another 50 to 75 bips cut in the year. So we could see the CBR go as low as 6.25% in the year because monetary policy remain key to supporting the economy. But fiscal policy, as you understand today, we have the budget reading. So we expect to see the complementary support that is coming from the fiscal policy to support the economy during this pandemic. So that's something to look out for today. In terms of interest rates, we see the fundamentals speak to need to have interest rates go up. Investors are demanding for higher yields on the treasury bills and government bonds, but the government has remained very adamant, trying to cut borrowing costs. But given the increasing budget deficit that is coming in the new budget, we expect the government to be heavily reliant on borrowing from the domestic market, and that could see an uptick on yields. And that is fundamental what should happen, given that government sovereign risk is also been shattered a bit. So we expect yields to be going up in the second half of the year. Looking at currency, we have seen the currency hit a low of about 107 to the US dollar. And that was mainly because of investors rushing to get the dollar as a safer haven against other currencies, especially in frontier and emerging markets. However, we do expect the shilling to remain quite stable. It has stabilized at about 106 to 107 levels, and that is heavily supported by the inflows that have come from the IMF, the World Bank, and other development financial institutions that have supported the country in coping with the pandemic. So the shilling could weaken modestly if the pandemic continues for the next 2 quarters, but we expect it to remain within sound levels, supported by the CBK intervention in the market and the heavy forex reserves that we have in the country. The CBK highlighted that they expect diaspora remittances, which are key in supporting the currency, to have a beating of about 15 to 20% in the year. So that is another aspect that could lead to the shilling weakening, but modestly in the year. Looking at the equities market and some of our outlook, we saw the market last year gain about 18.5% on NASI. And this year, the NASI is down 15%, almost wiping all the gains that were there last year. Last year, remember, the gains came from the removal of interest rate cap, which saw a rally in banking stocks and also Safaricom in the fourth quarter. This year, we expect the equities market to end on a negative territory. That is to say, we expect negative returns for the market this year. And that is driven by the fact that the pandemic has moved foreign investors to shift their interest to developed markets, which have gone conversely to economics because the stock exchange should be an indicator of where the economy is going. But as we saw in developed markets, equities are on a rally and the economy is on a recession. And the other reason we expect the market to end on a negative is because we have seen companies start to give out profit warnings. We saw EABL come out with a profit warning. We saw Nation Media Group come out with a profit warning. So we expect the market earnings to be lower as compared to last year. And that is largely on back of the pandemic. And as Catherine highlighted, we see pockets of value in the market. The market is trading below historical average at a price to earnings multiple of 11 versus a historical average of about 13.5. So there's a huge discount in market presented on some key counters that are solid for long-term investors and could resume to capital gains in the future. Just to highlight some of the stocks that we see holding value despite the pandemic ravaging, that is Safaricom, which continues to innovate and also be driven by M-Pesa, which is the wallet that everyone is holding today for money transfer, and also fixed data, as now the pandemic has seen most people working from home, fixed data usage has risen. And also on the banking sector, some of the counters we see holding value for investors are ABSA, INM, Equity, and KCB. We see these counters having attractive valuations. Dividend yield possibility is quite high. And also we see price rebound happening in the next 12 to 18 months to highs that we have seen in the last 52 weeks. And we also have quite a peak on EABL, quite innovative before the pandemic ravaged. They have been hammered because of demand concerns. People are not having the capacity to consume beer and all the other alcoholic beverages. But upon the pandemic wavering away, we expect the innovation and the plans they had put in place to contribute to them resurging. So to speak further on this, I'll now invite my colleague, Business Development Manager, Samuel Gishohi, to give us further insights. Sam, over to you.
Thank you so much, Dennis, and thank you for a comprehensive cover of what is happening in the market. My name is Samuel Gishohi. I'm going to be talking about should we invest during the COVID-19 period. And to begin my presentation, I would like to point out just a few things that have happened. And the reality right now is that the reaction to COVID-19 was slow by most governments, and this has caused global stock markets to have shed a lot of a lot of value. And this is not just local, this is a global thing. And with our local market being roughly 80% foreign controlled, it means that when a lot of foreign investors panicked and a lot of panic selling happened, then we saw our market also tank by more than 20%, which is what we call a bear market. Now, the speed at which the market went down was actually worse than what happened in the Great Depression in 1929. And as a result of this, we did see at a point that the Nairobi Securities Exchange had to invoke what we call a circuit breaker, which means the market went down by such a big margin in a particular day that they had to stop trading for that day to reduce the impact of panic selling. And when this happens, it means that we did see a huge reaction that caused a lot of panic. And this means that many investors are sitting there feeling that they're boxed in because then they're wondering, should they run away from the market? Are they going to, is this COVID-19 going to wipe out all of your investment earnings? To move on to the next slide, the question we go on now and begin to ask ourselves is it all doom and gloom, or are we going to see some sort of opportunities coming out of this? And a sampling of various economist views and various people who are commenting on what is going on in the market, you're going to see that yes, we are expecting a major economic downturn, particularly in sub-Saharan Africa, especially because our governments are not very well equipped to handle the sort of financial turmoil that is going to happen. We've seen Western and other regions being able, the West and other regions being able to finance and to mitigate the costs and to be able to provide food, for example, and shelter and all other things to help the economy, of course, which I think Dennis has mentioned in his discussion. And we have seen swings. We have actually seen that there has been huge swings in both commodity prices and also stock prices, where we, for example, 2 weeks ago, we did see KCB go from a low of around 35 back to 42, in which case we are seeing quite a bit of volatility, which means even in this period, there's still a lot of opportunities for investors to do something. But again, that sort of volatility can be very scary. And so a lot of people are scared. The IMF also announced that we expect global GDP to decline by about 3%, which means we could be seeing a bigger depression than probably what happened in the Great in 1927, and that in itself is causing a lot of panic. It's causing a lot of fear. It is causing a lot of anxiety among investors. But on the other side of it, moving on to the next slide, you're going to see that there are those investors who are seeing an opportunity. And from an investor's perspective, it is good news. If you look at, for example, some valuations of companies, and as Dennis alluded, we are seeing some value stocks which seemed to be beyond, overvalued around January and late 2019. We are starting to see them coming to prices that are undervalued. They're bargain prices, and this means that this is an opportunity for investors who are feeling that the market is overpriced to be able to come in. It means that with interest rates also low, it means it's a very good time for investors to be investing in different regions, particularly in Africa. And also, we are looking at price levels, which, as Dennis mentioned, are the last time we saw this sort of prices was when interest capping happened. And we did see a similar drop when interest capping happened, and when interest capping happened, there was a huge slump, especially in the financial stocks, and a lot of investors panicked and felt that they should sell. But those that stuck in there and managed to at least take some action, including averaging down, at the end of the day, by the late 2019 and early 2020, they were laughing all the way to the bank. So I think this is an opportunity. COVID-19 is not going to be sitting with us for a very long period. I believe that as governments open up, we are going to start seeing a sort of relief from all the problems we're going through. Moving on to the next slide. So the question that most of us must be asking is, what do we do? Of course, first of all, keep calm. This is a hiccup. It has happened before. We've seen market crashes. We saw the credit crunch crisis. We saw the interest rate capping affect the market. Now it's COVID-19. And in all these cycles, we have seen the market recover. But before we go into the investment side of things, it is also important to look at how your current financial status is, considering the expectations that we are going to be in this new normal, as we call it, of COVID-19, contact, of COVID-19 mitigation period, in which we are going to see a slowdown in economic activity. Some of us are not going to be, we are going to be on compulsory, probably unpaid leave. Most Kenyans have side hustles. It means probably right now your side hustles are not bringing you some money. Maybe you have things in the entertainment industry, and those investments will not be bringing you that extra income, which means your disposable income is low. So first thing you need to look at is yourself. What are your emergency savings like? Usually you're supposed to have about 3 to 8 months of emergency funds somewhere. And these emergency funds are very important. So you need to look at them, make sure you have them in place. Also be very clear about how much you need for, say, 3 months, how much you need for the next 3 months, so that you have a sort of time structure to when you need these funds, so that you can be able to think about where you can put them. And once you know when you need the money, then you can be able to decide, am I going to put it, say, in a unit trust? Am I going to put it, say, in a interest-bearing instrument, financial instrument, so that in the 3 months or the 6 months when you expect it, or say 9 months, and for those of us who are sitting better in a year, that you can continue to earn from that. And then you make a decision that at that point, or when I earn the interest, what am I going to do with it? Is it money I can take more risk with? So then we come to risk tolerance. How much risk tolerance can you take? And at this point, I would like to emphasize, especially for those who have already done the risk profile, and we do risk profiles for free. We're going to give you our contact, and you can just request a risk profile. We will send it to you, and you'll do the questionnaire, and we'll give you a feeling of what sort of risk you are able to handle. If you've done it before, it would be a good idea to do it again now, because your aversion to risk at this time, or during this COVID-19 time, might be a little different, or much different actually, from when the market is good. And then how much do you actually have? Again, you need to be careful not to be putting money that you need in investment. So you need to figure out how much of your income or how much of your savings are disposable income. We have low risk asset instruments. For example, I mentioned we have the money market unit trust funds in wealth management. We have even certain shares that are defensive and are very stable. And so if you can put away and create a habit of having 5, 10, or 15,000 or 20,000, which is affordable to you, and you're able to put in investment, then you can consistently build a portfolio. And this is also a very good thing to do even when markets are good. Moving on to the next slide, let us look at the things that you should do and the things that you should not do or you should avoid during this period. First thing is, don't panic. A lot of people panic and sell their investments and say, I don't want to be in this market ever again. Of course, as stockbrokers, we are always blamed for having told you that a share was good and now you're seeing it at half the price. And you're wondering, okay, was it good advice, or was it the wrong advice to take? And we must realize that the loss right now is still a paper loss until you sell. You don't lose money until you sell your shares at a low price. So you need to be careful. Don't sell in a panic. In fact, what you need to be looking at now is, what is the quality of your portfolio holdings? What is the quality of the shares you hold? Look for value. Those ones that are stable and strong, keep them. If you have those, what we call value traps, or those companies that are not doing well, some of them are even technically insolvent, it would be a good idea to be thinking, okay, their prices are low, I've made a big loss, but if I sell them and buy a better quality stock at a low price, which one of these two is more likely to gain in value? And you're going to find that we can restructure that. So come to us, we'll discuss how we can restructure your portfolio so that you're best positioned to take full advantage. Don't put your money before your health. our health is important. COVID-19 is a reality, and so we have to make sure that we are always taking care of our health first. Make sure you have enough for any eventuality in terms of health issues. Don't shy away from diversification. Try to make sure that you still have diversification. Yes, some sectors are a bit difficult to invest in right now, but again, there are things you can invest in right now which will gain after, and we're going to see towards the end of this that there are certain sectors which will recover very fast, and right now, after the COVID-19 issue, and right now they're actually at very good bargain prices. Don't give up on your retirement savings. I think that also goes with not panicking. Yes, they might have been reduced in value because of this period, but again, this is not a long-term thing, so it is still a time to continue to have a percentage of your savings in stocks and a percentage of your savings in other investments for the future. Don't focus on price, focus on value. Again, I've seen a lot of people coming and saying, hey, there's this stock that is trading at 1 shilling. If I buy it, it is likely to go to 2 shillings and that will double my money. But the question you need to be asking yourself, if it was, say, at 10 shillings and it's at 1 shilling, was that caused by COVID-19, or is the company itself a toxic stock? Is the stock toxic? Is the company suffering? Is it probably technically insolvent? And so that means that you're buying into a toxic instrument, and that the chances of that coming back to that 2 shillings are almost zero. I would rather be buying something at, say, 35 shillings and knowing from its stability and its profitability and the sort of income and the sort of business they do, they are more likely to go to 40 or 45, and that will be a better stock to be taking up. Trim your spending. We have gotten used to the good times, and sometimes we sort of have a lifestyle inflation. So again, reduce the sort of spending you're doing. Consider a refinance. These are the things you need to do. Consider a refinance. Interest rates are down. Right now, I'm sure financial institutions are willing to listen to how you can renegotiate and refinance your loans so that you're paying less and then you're creating more disposable income. Average down aggressively on value stocks. Again, if you bought, say, the KCBs and the equities at 54, 55 when they were very high, and now they're at 35 shillings, then keep buying, because as you keep buying, then you're bringing down the price at which you initially bought. Choose well-established names over small ones. Again, you want to be looking at defensive counters. You want to be looking at, say, utilities. You want to be looking at those companies that have big market share. They're giants. Their incomes are predictable, and they're more likely to survive this period. Again, I cannot say this enough times. Evaluate your risk profile. Again, let us look at your risk profile. Has it changed? Do we need to restructure your portfolio so that you're holding stocks that are more in line with your current investment profile? Moving on to the next slide. It goes without saying, cash is king. When you're liquid in this period, you're able to take advantage of investment opportunities that are arising now. So focus on being liquid if you can. Make sure you're putting your money in areas where you can reach the cash when you see the opportunities. But of course, don't use money you need in riskier investments. Again, make sure you're using your money for the right thing. If your shares have not yet dropped and you feel that as we go ahead, as the economy becomes more squeezed because of course the effects are still beginning to be felt, then you can sell those at the price at where they are. And if you expect them, say, to drop by 10, 15 or 20%, you can rebuy them back at that 20% down, and you will have sort of reduced your risk. And also when they start going up, you will have more upside, and you can create value there. Understand how COVID-19 will affect different industries. I won't go into this too much, because at the end of this, I'm going to just show you a few sectors, and we are going to see what we are now calling the stay-at-home stocks, or the stay-at-home companies that are good to invest in at this time. Prepare a watch list. If you go on our online platform, you're going to see that you are able to create a watch list. You're able to have to follow certain companies and be able to see how they are acting. So if you're interested in them, you'll be able to see how the price movement is, where are the lows, where are the highs, when is the time to get in, and of course in consultation with us we can be able to target them at the best prices. So try to go on the online platforms. They give you real-time access to the market, and that will help enable you to be able to follow the market easily. Of course, keep averaging down on those ones that those selected companies that are already in loss, so that you can bring down your price. Look for undervalued quality stocks. Again, this point you will notice has come up in every slide. Look for value. Look for value. That cannot be said more. Value is king. Information is the key, and we are here to give you information and to discuss with you what is best for your portfolio, what we expect. Of course, we are not always right, but based on the research, as you saw, Dennis has a lot of information that we can use to try and figure out what is going to happen next and what the expectations are based on previous and also projections that they make using financial models. Moving on to the next slide. As you can see, John Templeton, one of the greatest investors of our times, said the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. And right now, I can assure you, if you look at the mood, look at the newspapers, look at what is being written about global markets and stock markets, and even locally, it sounds it sounds gloomy, it sounds like doom. But this is the best time, and this is the signal that you should be considering to actually be getting into investments. Moving on to the final slide. And now I have a table there just showing you the different types of what we are calling the different categories and the expectations in these areas. Of course, some of them are not necessarily, we don't have necessarily companies trading on the securities market that are in these sectors, but again, you might have investments out there that are outside, and investment, to be honest, is a culture, it's a habit, it's something that you cultivate in yourself. And therefore, if you look at this table, you're going to see that there are those that we expect they're just hibernating during COVID-19, and when COVID-19 issues go away, then you're going to start to see them recover very quickly. And those are in food processing, tea, coffee, textiles, restaurants, pubs, food vendors. So any companies that are in that area, including automotive, you're going to start to see them recover once the COVID-19 problems ease. And so there are places that you can actually be sitting. And then we have those ones which are going to have a high impact and will recover very slowly: hospitality and tourism, private sector education, retail trade and beauty products, heavy manufacturing. You can see cement there and mortar. So you're going to notice that those are going to tend to be slow, but will eventually recover. Then we have the quick recoveries, the new winners. And this will be mainly in ICT and health. Of course, you will find that some of them are also in digital finance, because then again, if you look at the way we are running, say, our business right now, a lot of things are going on to the online and the mobile applications. So again, jump onto those applications, jump onto those mobile offerings, because they give you access to the market, direct market access. We did see even Nairobi Securities Exchange also going into that space, trying to make sure that everybody has access. And we have a free platform that you can access and be able to see the market and be able to execute your trades and do whatever you need on the market. And this is the time to take advantage of those, including buying their stocks. Then there are those ones which will continue to decline even after the COVID-19 restrictions are eased, and mostly business tourism. As you can see, in a meeting like this, we usually would have it, say, at a meeting room and have our clients come there and we have this discussion face to face. But that means people will travel less for business meetings, people will have less conferences and do it more in this kind of digital platform. I think that is all I have for you today, and I believe that when we go into the question and answer section, we are going to see and be able to address those individual issues that you may want to raise. Thank you so much for listening to me. I would like now to invite our guest speaker and from the Nairobi Securities Exchange, Terry Adembesa, to to take us through what is called the next, or which is the Nairobi Securities Exchange Derivatives Market. Terence, karibu sana.
Thank you very much, Samuel, and the team from NCBA for having me today. It's a great pleasure, and I think based on the background that Dennis and you, Sam, have given, it'll be interesting to hear how participants, investors from your client book can participate in the derivatives market. Of course, Dennis has highlighted the enhanced volatility arising, of course, from the COVID pandemic. This has led to, of course, direct risk exposures on quite a number of traditional asset classes. Many investor portfolios have been adversely affected. This, of course, raises the need for risk management strategies. We are seeing for very long, the NSE was a one-directional market. So part of the ability to participate in the derivatives market is to give investors, an opportunity to, take the opposite side of view of the market. Derivatives have been there for a long time. These are not new. For those of you who subscribe to the Christian faith, the classic example of a forward contract would be in Genesis 29, Jacob's purchase of an option when he was asking for, Rachel's hand from Laban. There'll be a classic example of a derivative. But these markets began quite some time back, mainly because merchants in the commodity space wanted to find and ensure they were able to meet and negotiate on contracts for the ability to trade amongst themselves. Of course, post 2008, these markets have been split into two distinct segments. We have what they're called the over-the-counter markets, but also we have centrally cleared exchange traded markets, which are highly more regulated and have better structure. And this is one of the markets that the exchange has put out currently. Of course, there's been key concerns on derivative markets. Classic example is a famous quote by Warren Buffett, calling them weapons. There's been quite some number of highlighted cases, Barings Bank, Orange County, and some of these would make for interesting reading. But derivatives are basically is instruments that work like how your kitchen knife works. When in the right hands, they can prepare an awesome meal, but we also know that this in the wrong hands, the knife can cause quite a bit of harm. So just moving forward, Dennis, a derivative in itself is a contract, is a financial contract. It's an agreement to engage in a commercial transaction between two parties, where the two parties would agree on the delivery of the asset at a time set in the future. So a number of the requirements or specifications pertaining to that contract would be agreed now, but delivery of the asset would be in the future. So when we're talking about the specification, we could agree on the price, we could agree on what the underlying instrument would be, and the like, and this would be delivered in the future. So the derivative itself is a financial contract. The buyer in the futures contract is known as to hold a long position or simply to go long, while the seller in the futures contract is said to be having a short position or simply short. If you are on the long side of the contract and the prices go up, then you are considered to be in the money on the contract. And if you're on the short side of a contract and the prices go down, you're considered to be in the money. What this basically means then is that you are able to trade in a market not only when prices are going up, but also when prices are declining. So to trade, each party pays a nominal amount, what we call the initial margin. Of course, these products are leverage products. The exchange novates all trades, meaning we mediate and facilitate all trades. We are the central counterparty for all trades. The prices are bound to change, of course, during each and every day or trading session. And then the contracts are settled on a daily basis. Of course, the difference between the margin that you've paid and where the prices have moved to. So on a daily basis, the exchange would revalue the contracts, of course, based on what has traded, and would do this through a process called marking to market. So your contracts get a daily valuation, and you're able then to see whether your contract is in the money or is out of the money. In terms of a market structure, the clearinghouse is really the exchange. We have the clearing members who are the banks who process all trades. We have the trading members who are the investment banks. In this case, it's NCBA and your clients. And we have currently we have only these contracts listed: Safaricom, KCB, Equity, ABSA, EABL, BAT, and the index. These have been selected based on liquidity and the capitalization of these counters. As I said earlier, with these contracts, you trade based on margin. For example, the margin requirements for a Safaricom contract is about 3,000 shillings, approximately 11,000 of what we would term as the notional value of a contract. Trading fees are quite low. In terms of how much you pay on a transaction, if you're participating in a single stock future, you pay 0.17%, while for an index future you pay about 0.14. If you're assuming you're taking a trade worth Kenya shillings 1 million, on a derivative contract you pay about 1,700, while on the spot market you pay whereabouts of about 17,000 shillings. That just shows the comparison between the pricing between the spot market and the derivatives market. Of course, you can see trading in futures is significantly cheaper than trading in the equities market. I'd like to use this slide to just walk you through a trade example, assuming you have 100,000 shillings as a client and you'd want to participate in a derivative contract. Say you want exposure of about 250,000. Remember, we had said these are leverage products. The current contract that has been put out by the NSC is a Safaricom contract, which has a contract size of about 1,000. With the amount of money that you have, assuming the initial margin of 3,000 shillings, you should be able then to purchase about 10 contracts, which will give you about an exposure of about 250,000. Assuming the trade price is 25, and your total margin requirements would then be about 33,000 shillings because you're buying 10 contracts. The entry fees on that contract would be about 0.17 in, which is 425 shillings, and your exit fee on the contract would be about 408. So assuming on the 4th of August, the closing price of that contract was 24, how your profit and loss calculation is arrived at is really a difference between the price on closing 24th and the following day and the previous day, assuming it closed at, because you started a contract at 25 and the price closed at 24, you stand to make a gain of about negative 3,000. Remember, you've paid an initial margin of 30,000. your loss on that transaction is really the difference in the prices, 24 minus 25, times the number of contracts you've purchased, times the contract size, which is 10,000. So at the end of that trading day, you'd have a net cash of about 43,425. Remember, you started with 100,000 shillings. You've paid out 30,000 in initial margin, which is your initial fee. You've paid out fees for 425, and you've also paid an addition, what we call additional margin of 3,000 shillings. And these cash flows really are credited or debited to your account on a daily basis, so that by the end of, say, that week on the 8th of August, for example's sake, if the price had gone back to 24, then you'd be on a net position of about 89,000 on your contract, which basically means you've lost about 10,833 shillings from your cash. Really, the thing is that buyers profit from price increases while sellers profit from price decreases. So if you notice there are days where when the price increases, say from the 5th to the 6th, 22 to 23, then you make a gain of 10,000. But if the price moved lower, then you lose money. And this is really when you're a buyer on that contract. Next slide. And the vice versa would apply if you are the seller on that contract. Remember, we said that buyers profit from price increases while sellers profit from price decreases. So the contract, when you went into the contract, it was at 25 and you got out at 24. You've made a gain of about 10,000 shillings. Your net cash flow, of course, less of fees, would be about 9,000 shillings. So over and above the amount that you started with, which was 100,000, you'd end up with a net cash flow of about 109,167. So what did we see, on the derivatives market in the first quarter, January to March of 2020? Quite some huge gains, especially on investors who are on the short side of the contracts. Of course, we saw declines in prices ranging from 20 to 30% in these key counters. But you can see very massive gains on the futures side, especially if you're on the short side. Of course, the vice versa is also true. If you're on the long side of that contract, then you lost money. The assumption is that you, as an investor, you're probably holding the underlying security. And so if you then also are hedging your portfolio, using derivatives, and you take on the short side, then the loss on the underlying portfolio is mitigated by a gain on the futures portfolio. That just shows, an investor who wanted Safaricom exposure worth 25 million. What has happened in the period between Jan to March, with approximately 2.4 million in their margin account, which is, the initial margin and additional margin requirements. In addition to fees, they were positive on the contract if they went short by about 4.9 million. So, they put in about 2.4 million and made about 4.9 million. Of course, if you on the long side, which was on buying of a Safaricom, you'd have made a loss of about 5 million, which is about the same loss you'd have made if you are also holding the same exposure on the underlying securities. This slide basically just shows, for an institutional investor who, of course, would want to deploy a much higher amount, approximately 25 million shillings in ESCOF margin, in the Safaricom contract margin, this would give them exposure of about 257 million. Remember, in these products, you're trading on leverage. So a net return ending up, making a net return of about Kenya shillings 50 million. and this is if they're on the short side. The vice versa would also be true. This, derivative markets as really zero-sum products. So there, of course, would be a client on the other end would make a loss of about 52 million shillings. So the top chart basically shows what you would be doing based on the futures and the spot price. Given the decline in experience, for example's sake, on the Safaricom contract between January to March, you're able then to see that on the dip in the contract, anyone who was short on that contract would then be in the money. One of the biggest benefits of these products is that you're able to trade the different directions in the market. So at times you may want to go long, which is to buy. Sometimes you'd want to go short on the exposure of the securities. In summary, and this really has been quite a fast introduction into these products. You're able, as an investor, to hedge your portfolio. We've said if you're holding the underlying and the underlying securities on a bear run, as Samuel had said, you're then able to take an opposing or contra view on the futures market. In essence, you're able to hedge your portfolio, and this protects your portfolio against adverse price movements. There are various trading strategies that you can use. We've seen that the fees are much lower on the future side as compared to the spot side, but also by trading on an exchange traded product, you're assured of less counterparty risk because the exchange has stood in between the products, in between the two traders. So in this essence, you can be assured that if your contract is on the profit side, you definitely receive your gain, and if you on the loss side, you'll have to meet your obligations on the trade. We would be happy to take some questions going forward. I think this is a basic introduction on how the derivatives market has been working, and we'll be happy to liaise with the team from NCBA, to discuss a bit more in detail with you clients and around how you can participate in this market. Thank you very much.
Thank you for the presentation. And yes, as you've heard, if the market is going up or down, it doesn't matter. You could always make money while trading on the derivatives market, which is known as Next. And thank you, Samuel, also for the COVID-19 stock picks, the stocks that you should be buying while at home. So we do have a few questions coming in from Facebook as well as the Zoom. Let me start with, there's a question here from Richard, and I guess this one is for you, Samuel. Richard says he's always been a long-term horizon investor, well, since it started about 20 years ago. And granted that valuations may seem low, we are yet to see the real impact for COVID-19. But we'll see that come the reporting season. So he's wondering if it is about time that he changes his strategy from investing from a monthly basis to, say, a quarterly basis. He's also pointing out that the 50s are beckoning, so of course he doesn't want to miss out on any opportunities. But again, he's wondering, what to do, because he's also saying you cannot have it all. So what is your take, and what would you recommend for Richard, knowing that also markets can be rational longer than can remain solvent? Samuel, you're still on mute.
Sorry, thank you, Richard, for your question. And yeah, I really like that final comment you have said, that the market can remain irrational longer than one can remain solvent. Very important for us to know that. And I think if you look at some of the issues I was talking about earlier, it is very important, and right now cash is king. But again, how long will you have that cash? Now, to go into your question, I've always had this question, and not to say that we always say invest for the long term, but what does long term really mean? And the question is, do I buy something and I watch it go up and down and do nothing about it? Or do I buy low and when it goes up, sell it and look for something else? At the end of the day, as long as you're not taking money out of your investment portfolio, then it means you are reinvesting it, and so you're still investing for the long term. So the decision on whether you're going to be going into shorter periods in which you can look at the market cycles and see that at certain periods like this one, or like when we have market turbulence, you notice that certain shares which are very, very good quality will lose probably say 20% of their value. And at that point, you can look at where they usually tend to, or when you're expecting a sort of dip, and sell and buy them when they go low. Again, as you approach your 50s, I agree that you need to be a bit more risk averse. And so even if you're going to go into a more active trading kind of thing where you're buying low and selling high, you also need to be cognizant of the fact that losing or buying a losing stock at this time in your life could be devastating to the final or the end intention of investing in the first place. So it would mean that even as we're doing your risk profile, we are going to be putting on a little lower risk and probably go for the more defensive, the more stable, and the more value investments rather than looking at anything speculative, because then it answers to your long-term kind of investing style, but also answers to the safety that you need at your age, and also looks at how you can also increase by doing a bit of turnaround on that portfolio, how you can increase your returns on investments over the shorter term periods or the medium term periods. Of course, that makes you more than just sitting and waiting for dividends, because if you look averagely, the companies that pay the very good dividends in our market, which are the more defensive and more stable stocks, will be paying you roughly 8%, and on the high side 10%. But if you factor in inflation, then you are earning something like 6 or 7% in a year on dividends. But when you buy and sell, for example, especially in this period when we are seeing a lot of volatility, you will notice that you can make returns of up to 20 to 30% in a 3-4 month cycle. Thank you, Richard, and I'll be happy to continue this discussion so that we can seek the best and the most optimum investment portfolio for you. Thank you, Catherine.
Thank you, Samuel. We have another question here, which I will throw to Dennis. With banks experiencing an upsurge in NPLs due to COVID-19, what new measures do you envision banks will adopt when carrying out a risk assessment of their customers before lending?
Well, thank you, Catherine, and thank you for that question. I think some of the broad measures we have seen from the banking sector is first of all covering themselves by increasing their loan loss provisions because they anticipate that non-performing loans are going to spike. And we have seen the restructuring that is going on, with some of the banks restructuring about 25% of their loan book. And this restructuring is taking shape in the terms of principal and interest moratorium for about 6 months. So my thinking is that banks will tend to lend more to the government as opposed to the private sector. And if they're going to lend to the private sector, more stringent risk assessment is going to be taking place. Remember, when you're going to ask for a moratorium on your loan, they are also asking for documentation saying, perhaps you've lost your job and that needs to be documented and the reasons why. So it's just going to be more requirement for documentation and reasons why perhaps you need a moratorium, and also why you may need a loan at this point, and assessing your capacity to repay. Perhaps if you are a business, they're going to assess your cash flows in more in-depth measure. If you are an employee, they are going to assess your job stability in more depth. So those are the measures I think they could look into. But looking at the broader sector, the banking sector is seeking to retain capital, as you saw a bank like Equity Bank canceling their dividend payout. So cash is king, as Samuel had mentioned, and they need cash at this point, and capital preservation will be key. But those are the measures they could take into consideration when assessing risk for the private sector lending. Thank you.
Well, Dennis, I have another question for you, and thank you for that. Coming from Benjamin on Facebook. Is 1.5% growth realistic with a surge in COVID-19 infections in our country? So do you think that we will maintain that growth projection?
A 1.5% is absolutely optimistic. It is an optimistic case. If you look at the government is projecting 2.5% growth rate. So at 1.5%, we are seeing a slow recovery even in our own economy, like the horticulture sector is opening up. We are starting to export our horticultural exports to Europe and other markets. And we anticipate also that the fiscal consolidation that is going on with the government continuing with austerity measures, those are coming in on board. Despite the pandemic, they'll be able to cover up some of the gaps that exist. But the key concern will remain also the debt and how we are going to finance the budget deficit. But I think the recovery that we are seeing is going to be mainly from sectors that are recovering, mostly from horticulture and manufacturing and financial services. But 1.5% could be an optimistic target, but if the government is targeting 2.5%, we are quite pessimistic on that regard.
Okay, thank you, Dennis. Samuel, I think we have a question here from Lawrence Karanja, and he's just wondering, suppose someone has a 20,000 investment amount, where would you advise them to put this money if they're looking for more like low, medium risk or medium to high risk with good return? But those, I guess, are two different spectrums, because it's asking about low to medium risk or medium to high risk. What would you quickly recommend? But I think that's a discussion to have with Lawrence post this webinar.
Thank you, Lawrence, for the question. Well, you have 20K to invest, don't know where to put the money. I think your investment decision is directly linked to your risk profile. And yes, you have mentioned the low to medium risk and medium to high risk, which again, as Catherine has mentioned, are two different spectrums. I think currently where we are sitting, a lot of the investment decisions you would be making on the market are really straightforward and very low. You'd be able to make some very good investments in low risk, in low risk stocks that have very strong fundamentals. Because right now the market is discounted, and so it wouldn't really make sense to be going for the medium or high risk for now, but rather looking at those ones that offer you underlying stability. I won't go very deep, and as Catherine says, this is a discussion best had on a personal level because of your personal and individual preferences. But if I was looking, say, at the banking sector, then I'd be looking at the tier one banks. If I was looking at, say, companies like Safaricom, if you're looking at those companies that give you quite a bit of stability and also give you quite a bit of growth and have very stable profits, even when we are in a period like this, and we expect that they also have the muscle to survive this kind of turbulence and come out strong. Thank you, Lawrence, and I hope we can continue this discussion so that we can delve deeper into the exact stocks that we can be looking at for your risk appetite. Thank you, Catherine. Catherine, you're muted.
Sorry, thank you, Samuel. Just one more question here from, but it's anonymous. But the question is, speaking of value and growth, what are your thoughts on Centum as a stock in these times, considering the fact that they just recently retired their debt, and also actually Centum is set to release their full year results tomorrow morning. So do you have any thoughts? I don't know if this goes to Dennis or Samuel, but what is your thought on Centum as an investment choice?
Yes, I can take the question. Looking at Centum as a company, you have to look at the exposure towards real estate. They have about 60% of their portfolio towards real estate. And the real estate market as of now, you have to assess it, and for sure it's on a downturn. So you have to see the risk there, but also having retired their bond, they want to put the cash into a strategy that is focusing on private equity, and private equity is a long-term business. So the portfolios that they're going to pack into their business, that will determine how they do into the long term. So it's a long-term business giving their strategy. I think it's strategy 4.0, which will speak into how they do in the long term. But for now, I would say they have a risk, high risk towards real estate exposure. But looking at the results tomorrow, we expect to see good results for the past year. But it's a long-term business that you have to view very, very closely. We could talk more on this in the future.
Okay. Well, thank you, gentlemen. I think that will be all for the question and answer session. We will, if there are any questions coming through, we will address that with the customers of this webinar. So again, thank you. And if you are interested in more information on the derivatives, what Terry just gave us was a brief introduction, and it can be a very technical subject altogether. But that's where we're here for you. We are a trading member on the next market as well. So we are licensed to trade that for you in case of any interest there. You could seek further guidance on how to get into that market and what you need to do to get started. Now, with that said, I want to introduce, we're coming to the end of our webinar, but I would like to introduce Ms. Kathure Nyamo, our Managing Director at NCBA Investment Bank, just to give us a few remarks and close the session for us. Thank you and welcome, Kathure.
Thank you very much, Catherine. Thank you, participants, for attending this session. I hope you found it useful. The insights provided will help you make optimal investment decisions. As Catherine has said, we're here for you. We're here to engage with you even after this discussion. It is my extreme pleasure to thank Terry Adembesa. I always have a problem, who was our chief guest for his insights on the derivatives market. And as you've heard, it is an alternative asset for your consideration. It can also be a tool you can use to hedge or to diversify your risks. Please allow me to thank my teammates, Catherine, Dennis, and Samuel, for unpacking this subject. Especially during these times. I mean, the questions we've seen coming through are the questions we are also, as investors, grappling with. So thank you for that. Allow me to thank our marketing team for facilitating this engagement with you, our clients, our stakeholders. We don't take it for granted. And we all look forward to hosting you again as we tackle your concerns and provide you insights as to your investment decisions. And as Catherine has said, Samuel, the team, Terry, the NSC, we are all here to support you, our investors, to make optimal investment decisions. Thank you very much for your time this morning.
Right, then I will thank you everyone for dialing in once again. And this brings us to an end of this first webinar. And again, it is the first and not the last, so we look forward to hosting you again in the near future. Thank you and have a good morning.
Bye-bye.
Good morning. Bye-bye.